Hi everyone. So what if you can tackle volatilities the smart way through dynamic asset allocation, which is both convenient and robust? Hi, I'm Nidhi Chawla, the fund manager for SBI Dynamic Asset Allocation, active fund of fund. And this presentation will show you why investing in this fund can be suitable for you. So let's begin. So why do you think that there is a need for asset allocation? And what we believe is that, over the past many years, if you look at for an average investor, the gap between the investment return and the investor return is always very high. And why that happens purely is because of the emotional behavior that leads to actually, they changing their asset allocation or changing their asset allocation or investments at the wrong time, volatility being the leading culprit. So the solution that is there to the problem, which is quite evident and obvious, is diversification, which is within asset classes, across asset classes, and which is across asset classes in uncorrelated assets, and timing the asset classes well as well, which leads to a point to a multi-asset portfolio, which gives you a significantly better risk-adjusted return than traditional products. And why would you say that? Is because when you look at these slide, each asset class is actually has a very different return profile. When I look at the return profile along with the drawdown that happens between the asset classes. So while debt will be will is a lower drawdown, but is also a lower return asset. And similarly, equity, which gives you a much higher return, but obviously the minimum and maximum range itself is very high in equity. So how do you actually reduce the risk is by returns within an asset classes and actually diversifying away across asset classes. And this slide again shows you how the combination of an equity or debt leads to a lesser drawdown and a lesser standard deviation and a risk adjusted return being better than a 100% equity portfolio or a 100% debt portfolio, given there is a low correlation between the equity and debt that we actually put into the portfolio. Similarly, when we talk about these two graphs, just shows you in more like a graphical way that the returns that you actually generate may be higher in a pure equity portfolio, but the return that you generate in a hybrid composite portfolio is actually has a lesser instances of negative returns and still gives you a decent double digit average return and with a lower drawdown. So coming to now, as once we've decided that you have to have a combination of a debt and equity portion into your portfolio investment, what happens within asset classes itself also becomes important, and that comes takes us to the next level of investment, which is whether you want to invest into broader market or whether nifty will give a return, or even at some period of point of time within sectors, how does the sector performances changes. So when I look at this is across market caps, across styles, as you can see across many years, there are different time periods are actually define the returns that are there across market cap and styles differ across the years, and how as an average investor you will be able to capture this in terms of the market cap, in terms of the styles, or in terms of cyclical and defensive. It may be difficult to, or you may be able to not being able to actually achieve it through, let's say, a pure equity portfolio or a pure debt portfolio, or for that matter or pure equity portfolio, pure debt portfolio. Similarly, on the debt side, even on the corporate bonds and the 10-year GSEC returns, when you look at it, they're also not very correlated. So whether you want to play accrual today, you want to play duration today, also makes a difference to your overall portfolio return. So does what we believe is that you need the need for asset allocation is required purely because to get a better risk adjusted return into your portfolio with a lesser drawdown. The dynamic asset allocation actually provides that you're able to make the right modification in a better tax efficient way in the changing market cycles, which can be a source of alpha generation, and the diversification across asset classes with a overall lower correlation, such as debt and equity, will give you a steady returns over the long term. So here we actually present the SBI Dynamic Asset Allocation Active FOF. What this fund does is nothing but gives you a holistic investment solution where you're able to give a better tax efficient structure to your own investments which, yes, let's say if you would do you keep changing depending upon the market cycles, it changes your allocation within debt and equity, and within equity it changes the allocation basis where we are in the market cycle, across the market cap, across sectors, and across styles. So it actually gives you a overall holistic investment solution, where you don't have to worry about timing the asset cycles or timing the market cycles, and in a more tax efficient way, and in a lesser with a lesser impact cost, given the portfolio approach which we are taking through fund of funds. And so, like I said, I think the portfolio strategy clearly navigates through where we are in the cycle in terms of the downturn or a recovery or the growth outlook, where we are in terms of the investor sentiment, in terms of the fear versus greed, and the valuations angle, both in equity and debt, which will define my portfolio allocation across these styles, sectors, market cap, and within debt across accrual and duration. So, the first basic premise of this entire model, or the entire active fund of fund dynamic asset allocation, actually falls from our inherent in-house asset allocation model, which we have been running for a long time now, which gives us the basic equity and debt allocation basis the valuation where we are, earnings, and the overall investor sentiments. Then it boils down towards the thematic exposure, where depending upon the market cycles, it defines where we want to invest in terms of the market cap bias, defensive or cyclicals, or in fact, in terms of the styles, in terms of quality, growth, or value. And then it boils down, the final selection comes to the fund selection across the three buckets, where we'll be able to effectively assign the funds, the fund allocation. When I talk about the asset allocation, I think it's a counter-cyclical approach to investing. This is well established within our firm, which will give us the right equity asset allocation, which today basically shows a 60% equity allocation and 40% debt. And when we move to the second framework, depending upon where we are in terms of the macro earning cycle, the sentiment market cycle, and the relative valuations, the model will define the weights between the cyclicals or defensive, large and mid caps, and quality versus value. And this fund, I mean, the crux of the fund basically helps you to invest through the various cycles, whether we run the recovery phase, where, usually, as we've seen in our 10 to 15 years back testing data, value is the style that works better. Broader markets works better. And in terms of the sectors, the cyclical sectors actually does better. As we move on to the expansion phase, it gets characterized by growth and momentum. The market cap continues to remain a much broader, the much broader market that actually participate, and cyclical sectors investment starts to accentuate much further. Then comes, the slowdown phase, where, the styles actually become mixed because there's a regime change which is happening. The growth outlook is kind of mixed. It is getting into a slowdown mode, where the tilt starts to becoming towards the large cap and defensives. And then ultimately it goes to the downturn. We are not really talking about recession, because there is not a real recession that largely happens in a growth country like India, where, the style bias goes towards quality. Market cap continues to remain large cap bias, and the sectors continue to remain favoring the defensives. Now, when I look at today's construct, I think today's construct is somewhere between a slowdown and a downturn, or it can actually move towards recovery depending upon what happens over the next 6 to 9 quarters, as we are looking at where, from a recovery phase that happened from post-COVID from 21 to 24, I think there is certain slowdown that we've been witnessing in terms of the growth. But however, the valuations and the investor sentiment still leads us to a reasonable comfort in terms of the higher equity allocation to 60%. But within that, the tilt remains towards the large cap and defensives as of now. So what it does, it gives you an advantage with a fan approach, which is nothing but it is flexible. It will keep shifting between equity debt in a much more tax efficient manner and keep shifting between investment styles and market caps depending upon the evolving market condition. It will be much more agile as compared to what you would have as an individual investor would do in terms of shifting between the sectors, styles and equity and debt. And given the overall, given it is a fund of fund, and we'll be able to the liquidity the impact cost being much lower and at a lower and with no tax incidence, I think the allocation shift that we'll be able to do, which will be much more nimble footed as compared to what you could have done as an individual investor. So why SBI dynamic asset allocation? Lastly, I think it basically helps in terms of getting the best of both the worlds, in terms of getting the right hybrid exposure with the best of our own funds of the fund house. We have been able to showcase our tried and tested evidence formula for the asset class navigation, which we have been using for the last many years in our balance advantage fund, and recently also launched quant fund, and now through the dynamic asset allocation active fund of fund. And it just helps to add another layer of nimbleness and agility to build a nice holistic investment solution for you, where you don't have to take a call in terms of navigating these market cycles and investing into the fund, into various funds or across sectors and styles in a much more tax efficient manner. So the fund asset allocation will basically be would be investing into actively managed equity and equity instruments from 35 to 100%, equity actively managed debt and debt oriented schemes from 0 to 65%, with the rest 0 to 5% money market instruments. On the taxation part, it will be subject to on a long-term capital gains tax or 12.5% after 2 years of investment. So in a nutshell, SBI Dynamic Asset Allocation Active Fund of Fund provides you with a holistic investment solution, which is actually quite simple, scalable and transparent and consistent and backed by evidence, which will help investor in order to balance risk and capture market opportunities efficiently without the investors worrying about the market timing and changing trends. Given that the structure of the fund being a fund of fund, it will be much more. It's an adaptive and a nimble footed solution which will help you to invest through market cycles in a more tax efficient manner. So thank you, and we look forward to your investment in this fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.